In this video, I'm going to show you a fast way to assess a company's quality. Despite its ease and speed, this method is really quite comprehensive. My approach lets you quickly identify great companies, bad ones, and all the ones in between. Then you can decide, for example, whether you want to accept lower quality in a company in exchange for perhaps a higher yield or a faster dividend growth rate. Or you could just stick with excellent companies throughout your investing. It's up to you. Let's make sure that we're on the same page when we're talking about company quality. The main thing to understand is that with quality, we're talking about the company and not its stock. A company's stock, of course, is different from the company itself. A great company can be selling at a bad price, which makes it a bad investment, even though the company is an excellent company. Or a lousy company can be selling at a very low price, which makes it look like a good investment, but it may actually be a value trap. One of my purposes in making this video is to help you avoid value traps, or at least to know what you're getting into if and when you choose to invest in a low-quality company. Quality is a fuzzy factor. There's really no precise definition of it. But generally speaking, and for the purposes of this video, here's what I mean by a high-quality company. It's one with a durable business model, has stable and sustainable growing earnings. It has sustainable competitive advantages that give it an edge over its competition. It's a financially healthy company with a solid balance sheet. It generates consistent profits, generates consistent positive cash flows, and it pays reliable growing dividends. Not every company, of course, has all of these attributes, but there are companies out there that do have most of them, and the quality snapshots help you find those excellent companies. My quality snapshot system uses 5 ratings from well-known, trusted sources. I assign from 0 to 5 points for each factor for a total possible score of 25 points. And now I'm going to briefly explain each factor. The first factor I use is the Value Line Safety Rank. You've probably all heard of Value Line. It is a subscription service, but is available to many people for free through their local library system. This is a screenshot of the upper left corner of the electronic version of Value Line's analysis of Johnson & Johnson. And I show it to you to show that the safety rank being in the upper left corner is one of the very first things that Value Line displays about a company when it is analyzing it. I'm using throughout this video the company Johnson & Johnson as an example of all of the factors. And here you can see that Value Line has assigned a safety rank of 1 to Johnson & Johnson. Value Line says that its safety rank measures the total risk of a stock relative to all the stocks covered in its service, which is about 1,800 stocks. They also say that stocks with high safety ranks are often associated with large, financially sound companies. And it is in that spirit that I use this data point as a factor that reflects a company's overall quality. Here's how I score it. For its safety rank, Value Line uses a 1 to 5 system, which is just perfect for me because I convert all my factors into 0 to 5 points. I do need to invert the terminology. Value Line uses 1 as its highest rank, as we just saw with Johnson & Johnson, down through 5 as its lowest rank. I assign points where high is best, so Value Line's 1 converts to a 5 for me, and so on down the line. Also notice on this table, and you'll see it throughout the video, that color in my tables always denotes points being assigned. Dark green always denotes a high score, through light green, yellow indicating a middling score, orange and red indicating various flags or reasons for concern with a particular factor. Johnson & Johnson got a 1 from Value Line, so it gets 5 points from me on this factor. For my second scoring factor on company quality, I use another data point from Value Line, which they call their financial strength grade. Here is basically the same screenshot as the first one, but I've widened it out to show you that financial strength grade also appears at the top of Value Line's pages for analyzing companies. Again, I'm using Johnson & Johnson as an example, and you can see that Value Line has given Johnson & Johnson an A++ score for its financial grade. Value Line classifies financial strength in 9 steps, ranging from A++ to C. The grades are a composite score that they've developed to reflect things like balance sheet leverage, business risk, profitability and profits, cash flow, and a company's cash hoard, net of debt that it owes. In other words, Value Line's financial strength grade covers all of the things we mentioned earlier as reflecting financial soundness in a company. This slide shows how I convert the value line grades to points for my own system. The highest grade, A++, gets 5 points, and so on, down to B++ and B+, which sound good in life, but in Value Line's financial ratings, they're not really good grades. They get only 2 points, a B gets only 1, and anything less than a B doesn't get any points at all from me on my system. The third factor in my quality snapshot system is the credit rating that a company receives from Standard & Poor's. This display shows how I assign points. S&P's ratings use 15 levels ranging from AAA at the very top of their scale down to D at the very bottom of their scale. They make ratings in levels. I consider AAA and anything that's AA to be excellent and give it 5 points. I consider ratings with a single A, which by ratings I can mean that it is A itself. It could be A- or A+, to be very good and to get 4 points, and ratings in the BBB level, which could also have a plus or minus, to be adequate and get 3 points from me on my factor. In their explanatory materials, Standard & Poor's makes it clear that anything below a BBB level rating, i.e. below BBB minus, is not considered an investment grade for credit purposes, and I use approximately the same meaning for my purposes here with these quality snapshots. So any company that gets a BBB, less than a BBB minus, gets 0 points from me on this factor. Also, you'll notice in the light green section, I give companies that have essentially no debt or debt to capital levels of less than 10%, I give them 4 points, because it's pretty unusual for a company not to run itself without using debt, and I'm not going to penalize it for therefore not having a credit rating. So if a company doesn't have a credit rating but has less than 10% debt to capital ratio, I give it 4 points on this factor. There are only 2 companies in the world that have AAA credit ratings from Standard & Poor's. Johnson & Johnson, as shown here, is one of them, and the other is Microsoft. So Johnson & Johnson gets the highest grade, which is 5 points again on this factor in my system. My next rating factor is the MOAT rating on a company from Morningstar. MOATS are usually attributed, the concept of MOATS is usually attributed to Warren Buffett. And basically what MOAT means is a sustainable competitive advantage or advantages that a company has. Buffett describes that as like a moat around the castle being the company, that protects the company from the onslaughts of competition. MOATs allow companies to fend off competition and earn high returns for extended periods. And Morningstar recognizes 5 particular kinds of moats that it awards. The first moat is customer switching costs. These are genuine costs or massive inconveniences that prevent customers from switching from one product to another. I used to work for a company that spent a good year and a half maybe, installing SAP software to basically run all the financial aspects of the company. It was a long project, involved many people, involved retraining people, but what the company was trying to do was to replace a lot of little pieces of software, some of which had been written in-house, not all of which were compatible with each other, with one giant system that would handle all of the tasks of all these little pieces of software. Believe me, once having spent all the money, had consultants in, and making the shift to the SAP system, it'll be a generation at least before my old company changes out that system. It's a perfect example of customer switching costs. Network effects, the second kind of moat, occur when the value of a company's service or product increases for both new and existing users the more people use it. Perfect examples of this would be Twitter or Facebook, which becomes more valuable to everybody the more people sign up and use it. The third kind of moat, Morningstar calls intangible assets, which are things like intellectual property rights, patents, trademarks, government licenses, brand identities, all things that can prevent competitors from duplicating a company's products, or they allow the company to charge a significant price premium for its products. The fourth kind of moat that Morningstar identifies, they call cost advantages, which simply means when a company can undercut competitors on price while earning similar margins, or conversely, they can charge market prices but earn higher margins than the other companies while doing so. The last moat identified is scale and size, and this occurs in industries or geographic areas that only support a few participants. When a niche market is successfully served by one or just a couple companies, it rarely makes sense for new entrants to try to enter that market. And a perfect example of this is pipeline companies in a geographic region. Once a company has gone to the expense and gotten all the regulatory approvals and so on to build an oil pipeline, it usually doesn't make sense for someone else to come along and try and build a pipeline serving the same area. This display is a screenshot from the opening page, the leading page on Morningstar's evaluation of Johnson & Johnson. And I took a little piece of it to show you that Morningstar displays its moat rating prominently. And you can see that Johnson & Johnson here has been awarded a wide economic moat. And this is how I award points for Morningstar's moat ratings. They divide moats into three categories, which is wide moat, narrow moat, or no moat. Wide is the best, obviously. I give it 5 points. Narrow is in the middle, but very good to get a narrow moat rating, so I give it 4 points. I don't give 0 points to no moat, and the reason that I don't is that some companies, even though they're not awarded moat ratings by Morningstar on their rating system, some companies still manage to run fine, long-lasting businesses without a Morningstar assigned moat. In looking at hundreds of companies over the last few years, I've noticed that this often occurs particularly in the insurance industry. Morningstar generally does not award a moat of any kind to an insurance company because they think that insurance is highly competitive and most of the products are indistinguishable. But the fact of the matter is, from my point of view, that lots of insurance companies have been around for more than 100 years doing just fine with their particular business model. And there is, in fact, a fair amount of loyalty to insurance companies. Once somebody hooks on with an insurance company, they quite often stick with that company for the rest of their lives. I know I've done that with my insurance company. That would be an indication of where Morningstar can't find a reason to award a moat based on its 5 main identified criteria. However, it's simple customer preferences that give the company considerable protection around its business. People keep coming back, they keep subscribing, they keep paying their premiums in the case of insurance companies. Here's the last factor. It is dividend safety grades from Simply Safe Dividends. This grading system has been developed by Brian Bollinger, who founded Simply Safe Dividends a few years ago. The dividend safety grades are a way to measure the likelihood that a company will continue paying and or raising its dividend, or, looked at the other way, measuring the safety of the dividend from a cut by the company for one reason or another. In doing their analysis, Simply Safe Dividends looks at multiple factors such as payout ratios, debt levels, how long the company has been paying and or raising its dividend, free cash flow generation because dividends are paid out of cash flow, and the company's growth pattern in both profits and revenue. Sales, is the company growing in a way that suggests that its dividend will remain safe and indeed grow itself. Brian's scores, as shown on this display, range from 0 to 100, and they divide nicely every 20 points into 5 categories. And once again, that works perfectly for me since I use a 5-point rating scale. Here is how I translate Simply Safe Dividends safety scores into quality points. The top bracket, 81 to 100 points, gets 5 points from me. The second bracket, 61 to 80, gets 4, and so on down through the lowest bracket. If Simply Safe Dividends awards 0 to 20 points on its safety scale, I give it 0 points on my scale. And here is Simply Safe Dividends page for Johnson & Johnson, and its dividend safety score is highlighted right at the top. And we can see that Johnson & Johnson gets 99 out of the 100 points available. To be honest, I don't think SSD ever actually gives 100 points to any company. So this is basically the top score for Johnson & Johnson. And again, it would get 5 points on my system. And that's the last factor out of 5. This display shows how I interpret the points. I add up the points on each factor for a total score, which can be as high as 25. If a company gets 23 to 25 points, I consider that excellent. 19 to 22, I consider it to be an above average company and certainly very investable from a quality point of view. I consider a total of 15 to 18 points to be okay. Again, an investment grade company and perfectly acceptable. If a company scores fewer than 15 points on my system out of the 25 points available, I consider it to be risky and speculative and probably not investment grade. I don't think I am currently invested in any company that scores less than 15 points on the quality snapshot system. And that's how I create quality snapshots. If you're interested in seeing all 5 factors in one table, I will display that at the end of the video. And you can stop the video there and take a screenshot of the combined table if you want to get it all in one place and use the system or a version of the system if you want to make adjustments yourself. Before I do that, and to wrap up this video, let's look at 2 actual company examples and see how they score. Okay, here's the quality snapshot for Johnson & Johnson. I've been using J&J as an example throughout this video. I've noted each time that J&J got the top score on each factor, and here's how that looks when you bring it all together. It's all dark green. Each factor of the 5 is shown across the top. Johnson & Johnson's score on the factor is shown in the lower portion. They're all dark green because they all score 5 points. Total points 25 out to the left. And I would consider Johnson & Johnson, if I were giving a letter grade, that would be an A+ for me. Anything between 23 and 25 is an A. It's excellent. 25 is really special, however. It's very rare to see a company get 25 total points for its quality snapshot. This table shows the quality snapshot for Aflac, the insurance company. The value line safety grade was a 2 rather than a 1, so there was a 1-point deduction, and we see a light green score, which means 4 points. The value line financial strength grade was an A, which is third one down, so it gets 3 points. The S&P credit rating is a good A-type grade, gets 4 points. I mentioned before that Morningstar tends not to give MOAT ratings to insurance companies, and that's the case with Aflac. Aflac gets no MOAT from Morningstar. However, the Simply Safe Dividend safety grade on Aflac's Dividend is the same 99 points that we saw with Johnson & Johnson, meaning that Aflac gets 5 points, top grade on my rating system. So in this display, the colors indicate the points. Light green indicates 4 points, yellow indicates 3 points, the orange indicates 2 points, and the dark green indicates 5. You add them all up, you get 18. That's more than 15. I consider Aflac to be a solid investable company on its quality factors. It's not in the same range as Johnson & Johnson, but nevertheless, it is not a company that I would eliminate from consideration for lack of quality. Okay, everyone, that's the end of this video. As I say goodbye and thanks for watching, here is the system summarized in a single table, along with a repeat of how I interpret the total scores. So long, everyone.